Hello everyone, let me introduce myself. My name is Dindi Novia Risma Putri. In this video, I will present material about return and risk of a single asset. Return and risk of a single asset are essential concepts in investment that help investors evaluate the potential benefits and uncertainties of putting their money into one particular asset. Return refers to the profit or loss gained from an investment over a certain period. It can come from an increase in the asset's price or from income such as dividends or interest. For most investors, the main goal is to achieve the highest possible return, as this represents the reward for investing their money. However, every investment comes with risk. Risk is the possibility that the actual return will be different from what is expected. In many cases, this means that investors might receive lower returns than anticipated or even experience losses. When investing in a single asset, such as one stock or one bond, the level of risk is generally higher because there is no diversification. This means that all the investment outcomes depend entirely on the performance of that one asset. If the asset performs poorly, there is no other investment to offset the loss. The relationship between return and risk is often described as a trade-off. Generally, assets that offer higher potential returns also come with higher levels of risk. For example, stocks tend to provide higher returns compared to bank deposits, but their prices can fluctuate significantly in a short period. On the other hand, safer investments like savings accounts or government bonds usually offer lower returns but provide more stability. Because of this trade-off, investors need to consider their risk tolerance, which is their ability and willingness to accept uncertainty and potential losses. To better understand risk, investors often analyze how an asset's return changes over time. If the returns are relatively stable and predictable, the asset is considered less risky. In contrast, if the returns fluctuate widely, the asset is seen as more risky. Historical data is commonly used to assess this, although past performance does not guarantee future results. Other factors, such as economic conditions, company performance, and market sentiment, can also influence both return and risk. In conclusion, return and risk are closely related and cannot be separated when analyzing a single asset. Investors must carefully evaluate both aspects before making decisions. Focusing only on high returns without considering risk can lead to significant losses, while being too cautious may result in missed opportunities. Therefore, a balanced understanding of return and risk is necessary to make smarter and more informed investment choices. Hello everyone, let me introduce myself. My name is Dindi Novia Risma Putri. In this video, I will present material about equity and valuation models. Come on, follow the material.